drives passive investment in corporations? Well, part of it is the difference in tax rates between personal income tax rates and corporate rates. So there's now a difference of approximately 37 percentage points between the difference in top personal rate and the small business rate. And then the second part of the slide shows the increase in the number of corporations. The part that's going up is CCPCs. The very top line is public corporations and private corps that are not CCPCs. And then the declining line is individuals with self-employment income. So, and then just over the longer horizon, in 72, there were about 240,000 corporations in Canada. And in 2015, we had about 1.9 million CCPCs. So that's a significant increase. So what do we see? I guess kind of we've got, as I was talking earlier about, you've got how much tax would be paid by an individual earning amounts directly, and the equivalence theory is that if we're appropriately integrated, if that same amount of money is earned through a corporation, the level of corporate tax and then personal tax received should kind of even things out so that the person's in roughly the same economic position, whether they earn directly or indirectly. And what we've observed is that when we talk about passive investments financed by retained earnings in a corporation, particularly those retained earnings coming from income tax to the small business rate, there's a significant advantage to retaining that money in corporate solution and investing it, and then later dividending it out, even when the person's paid, the refundable dividend tax on the refundable tax within the corporation, and then tax on the dividend. And we think of this as a deferral advantage. And I guess the easiest way to think about it is, if you're talking about income taxed, if you're talking about $100 earned, well, that you're going to pay tax on and then invest, if you're taxing at the small business rate, you've got $85 available to invest. If you do it through your corporation, and it's you're eligible for a small business rate, whereas if you're not directly, you only have $50 available after paying the initial tax, and that can create significant advantages. So when the rules were first designed in 1972, they actually recognized this problem, this issue with the design of the tax system, and imposed, or at least put in legislation a Part 5 tax, which would ensure integration. And the idea was that if you earned income that was subject to corporate level tax, and then you were going to then invest it passively, you would pay a top-up tax to put you at the same position, and then you would go on and be subject to that tax. And then if you pulled that money back into your business, you would actually get a refund on sort of the initial clawback tax that you had paid. Now, I'm not entirely sure whether it actually ever made its way into actual, being applied, but it was withdrawn in 1973, and at the time, I think it was the finance minister said, "I believe that these small corporations which enjoy the benefit of the lower rate of tax will in fact use these savings to expand their business, to improve their technology, and create more jobs for Canadians. So I think sort of the policy decision was in respect of the complexity that, in general, the expectation was that the amounts would be put back into business. So having recognized what was seen as this issue with respect to passive investment income, what the paper does is purport to, it puts forward a couple of proposals for ways to deal with this passive investment income, and lays out two broad approaches and seeks comments. So the first one is sort of a reintroduction of a Part 5 tax with adjustment, and that would apply initially upon the income being earned and subject to small business rate, and determination would be made as to whether or not it's used in the business or not. Sorry, yeah, I've sort of anticipated that. So there would be an additional 35% additional tax, and it would be refundable if the assets really are used to reinvest in the business. And then passive investment income would continue to be taxed as per our current rules. There's been a number of issues, raised with respect to that potential approach. Issues with respect to timing of refunds and things like that. The other approach is a deferred taxation model with sort of two possible approaches with that. One, an apportionment approach, and the other one, an elective approach. And just to quickly discuss the apportionment approach, essentially it would require taxpayers to track what is after-tax earnings that have been subject to small business rate, after-tax earnings that have been subject to general rate, and other amounts such as contributed surplus, which presumably have already been subject to tax at the personal level. The current system we've got with refundable tax and then payment of dividends would work correctly with respect to the amounts contributed by surplus. With respect to the other two amounts, there would be a non-refundable tax of essentially sort of a 50%, and then you would designate which pool the dividends came out of and would receive the appropriate dividend tax credit. As an alternative, the paper contemplates a system where we wouldn't be tracking, and effectively the passive investment income under the default treatment would be subject to non-refundable tax, and dividends would be non-eligible. And in other corporations that earn mostly income tax generally elect to treat their dividends as eligible dividends if they're willing to forego a small business deduction, and both options to this contemplates the setting up passive investment vehicles, which could be subject to these existing rules. So the obviously what the paper does in respect of a passive investment is describe the issue and provides some possible approaches. It's certainly not a complete description of any of them, I don't think, in terms of transitional and things like that. What the paper does do is seek feedback in a number of particular areas, and including transition issues. So I'll just leave that there and pass it over to other speakers. Thank you.
Good evening, everyone. Well, first I want to thank the CPA Ottawa Organization Committee for throwing out this big event for us in such a short time frame. I know Dean and I know Dean has worked very hard with the other members to get this event going, and I want to thank you personally also to giving me the chance to speak tonight. In all fairness, you can raise your hand if you'd like to skip the rest of the presentation and go to question period. So we won't keep you waiting too much. The way we want to do the presentation is to provide a practitioner's point of view on the proposed rules and how it will affect your client and what should be done now and in the future, or at least prior to December 31st of this year. So in trying to selling the changes to Canadians, the government has used strong words. They've been talking about closing tax loopholes. They've been talking about having the high-income earners paying their fair share of income. And we all know that the rules will apply to any Canadian entrepreneurs that is incorporated, regardless of business size or income. And what's interesting also is when you look at the finance documents that was released with the proposals, you see first that the measures with respect to income sprinkling, the additional revenues expected is $250 million a year. So macro, that's not a big chunk of amount when you look at the government spendings and the government budget. So you really have to wonder, is it really closing such a big tax loophole? Is it really a tax base erosion that we are having here? And we have to wonder, we have to balance this number with the level of complexity and the level of compliance burden that's going to put on Canadian entrepreneurs. And ask yourself, is it really worth it? With respect to the tax measures for passive income, although there's no proposals on that, and with respect to the surplus stripping, I would call, the document says that the government is not in a position right now to quantify the additional revenues that will be generated by these new tax measures. So it's kind of interesting to see that the government doesn't know what's going to be the tax cost to Canadian taxpayers of these changes. I understand it's probably hard to put a number, but maybe a range would have been interesting to see. So let's start with the TOSI, the income sprinkling. I know the way the government attacks TOSI is trying to find a genuine, a good policy rationale to tax split income more widely to family members, adult family members, and people related to the sprinkler. But when you do this exercise, you have to and by the way, the slides will be available afterwards because we'll have to kind of jump in. We have over 40 slides, and Dean has told us many times that we have 40 minutes, so we're going to stick with the 40 minutes, don't worry. So we're going to provide the slides afterwards if you want to take a look at it. So I was saying, when you're trying to build a policy rationale to justify doing TOSI, imposing TOSI to adult, non-active family members, you also have to look at key aspects that I've highlighted in those slides. And something of interest is the fact, for instance, that in the case of married couples or common law partner in most of Canadian provinces, if you divorce, you'll have to split some economic growth of your business with your spouse, if and maybe some income going forward. So what is then so wrong during marriage to share some form of economic growth and some income stream? Another interesting fact here is the fact that how you reconcile the tax policy that's being developed with respect to income sprinkling with the fact that income pensioners can split their income since 2007, and I don't see any changes to these rules in the package that was released by finance. So how do you reconcile these policies together? So I think when you're trying to build a good policy rationale, you have to take those key aspects in consideration. Otherwise, it simply looks like a politically oriented stunt. I now pass the mic to Jacob to talk about the tossing, and I'll be back with the capital gains exemption.
All right, thanks, Jonathan. So I'll clear out the elephant in the room right now. There is at least one person in Canada with blackberries. I want to echo Jonathan's sentiments and thanking CP Ontario for having me here today. Thank you very much. I want to, when we talk about all these rules and there's a lot of bad things that are coming for taxpayers. I guess one thing to keep in mind is things could always be worse, right? So at least Prime Minister Trudeau does not have an active Twitter account. So I think Ted's done a good job of summarizing all the rules for TOSI. I don't want to rehash what he's already talked about, but what I want to do today is speak from a practitioner standpoint about how I see these rules impacting my practice, and presumably a lot of practice out there for the folks in the room. And also flush out some things that maybe people haven't even considered about that possibly Ted should be considering. So in terms of issues I see with the TOSI rules, one big one is complexity. And so there's all kinds of newer extended definitions that are released as part of these proposals. Terms like specified individual or connected individual, an extended definition of who is a related person, split income, split portion, excluded amounts, a lot of complexity involved. And on top of that, within the legislation, there's talk of reasonability tests, different tests that apply for an 18 to 24-year-old versus somebody who's over 25. And when I look at these things, I step back and in finance's paper, they make reference to the fact that there's 1.8 million private corporations in Canada. And there's an economist that spoke on Monday, and in his set of facts, he indicated that there's, of those 1.8 million private corporations, there's 840,000 corporations with net income of between 25,000 and 100,000. So again, the middle class hasn't been well defined as part of this whole process, but to me, somebody with income between 25,000 and 100,000 ought to be considered middle class. And so it's these very people, the wealthy people are going to contact people like us in this room for advice, and we're going to help them navigate these rules. But when we talk about complexity and these 840,000 corporations with limited income, my fear is that the do-it-themselfers will be caught in a lot of these complicated traps. Which brings me to the discussion of what is reasonable. And so I'll throw out a couple examples. So one is, imagine a 20-year-old going off to university, and maybe the family's got a part-time business. And while they're at school, they work part-time for the family business, and they attend school. 4 months during the summer, they're at home, and maybe they work full-time during those 4 months. And then in the fall, they go back to school for another 4-month term, again, working part-time for the business. And so does that type of work constitute an actively engaged person who's performing duties on a regular and continuous basis as required by the reasonableness test for an 18 to 24-year-old? I'm not sure. And also, what would be a reasonable compensation for that individual? Again, it's unclear. And the second example I'd give would be for spouses, one of whom is active in the business, and the second spouse who's inactive for whatever reason, whether it be personal reasons or family matters, dealing with kids at home, that sort of thing. How do you possibly measure, quantify what value that person, that inactive spouse is adding to the business, whether it be indirectly, by making sure there's dinner on the table and the kids are looked after, but also directly in terms of helping with the bookkeeping or helping with things that come up along the way. Not to mention the fact that that spouse is also taking on a lot of risk along with, hand in hand with that active business owner. How do you quantify that? And I think that's going to be a challenge that was alluded to earlier, is going to have to be decided by courts, unfortunately. I want everyone in the room to think back to their latest experience with the CRA auditor and think about how confident you would be in that person to deal with these rules in an objective manner. And I think, if we did a show of hands, I don't think there'd be many hands that would go up suggesting that they'd have confidence in that. And on the slide here, I mentioned that size doesn't matter, and so what I'm referring to there is that clearly the biggest tax benefit from income splitting is for the range of income between 0 and 35,000. And so at that point, on dividend income in Ontario, you might pay next to 0 personal tax. And so presumably that's the range of income that finance and CRA would take the most offense to. But in my view, it's also the range of income that's presumably the most easy to defend in terms of a reasonability argument. And so I think there'll be a lot of butting of heads over relatively small amounts, $10,000 or $20,000 dividends. And I kind of look at it and go, is it really warranted? I wanted to run through quickly. This has been less talked about in the media, and so I wanted to draw this out for people who may not have considered this. But there is an element, in my view, of retroactive taxation as part of all of this. So I've got a simple example here. You got husband and wife, they're 50-50 shareholders. They march along through their business. Husband's actively involved in the business. Wife is inactive. They get to a point where they're near retirement, they seek financial planning advice, and they're told, yeah, you know what, your company's worth enough money, we think you can now retire. And so they seek professional advice, and they're told, okay, do an estate freeze, we'll give you preferred shares equal to the value of the shares you own. Let's call that number $2 million, to throw a number. And in this example, I assume that maybe the daughter is now actively going to take over that business and continue on. Seems like a fairly typical set of facts. And as part of the strategy, there would be a plan to redeem husband and wife shares over time through retirement. And by doing so, they'd access graduated rates and lower taxes throughout. I think the issue here is that under these new proposals, wife who's always been inactive in this business is now going to be caught by TOSI in my mind, because husband and wife are both specified individuals. Daughter is now a connected individual in relation to the corporation. And so what was expected to be low graduated rates throughout retirement is now, in my view, going to be subject to high rates. And not only that, but I think there's some concern over whether husband would be able to access graduated rates. I'd like to think that would be the case. But presumably he'd be relying on some kind of reasonability test as well. So my question to Ted, and hopefully we can get an answer to this tonight, would be, finance has made representations that there's going to be a grandfathering of passive investments within the corporation, and that existing wealth won't be impacted by these proposals. I just don't see how that's going to apply in respect to TOSI, and I don't. To the extent that people have planned their retirement, plan their affairs accordingly, now going to be caught by these proposals. So I think we've been talking to Henry Warren about trying to come up with some planning ideas to get around some of these rules, and I think I got the silver bullet. Air Canada has one-way tickets to 125 different countries. I love that. So in all seriousness, there is some planning that can be done so that the rules for income splitting take effect January 1st, 2018. And so clearly that's left the door open for the rest of 2017 in terms of potential income splitting. So I think the message is, where possible, you want to probably think about boosting dividends to inactive shareholders. take advantage of graduated rates while you can. On the screen here, let's talk different dividend levels, assuming no other income for these people, and what their taxes would look like in that scenario. So that gives you a sense of, obviously, the further to the right of the scale you get, the less benefit there would be from income splitting. But I think those are the discussions you have to have with your clients. And so the only other thing I'd mention there is that possibly you should consider RSP room as well. So to the extent that family members maybe got 50 grand of RSP room, just blowing out 50 grand more of dividends and using that RSP room in 2017 makes sense. Possibly, I guess it's going to have to be a case-by-case analysis. So moving to 2018, there's kind of limited planning you can do. Obviously, to the extent possible, you want to get inactive family members more active in the business to help support the reasonability argument. There's going to have to be some rejigging of family compensation in the sense that if an active shareholder was effectively 50-50 with an inactive shareholder, well, now more of that income's got to be rebalanced over to the active person. And I think it's incumbent on all of us to make sure our clients are aware that I think you have to take the view that you're into TOSI unless you can prove you're out of TOSI under these rules. And so it's incumbent on us to tell our clients to make sure they start keeping records as to what they're doing for the business, whether it's a list of duties, logging hours, as silly as that sounds, where appropriate, these types of things, so that in the event of an audit, you have a leg to stand on. So with that, I'm going to turn it back to you, Jonathan.
So let's talk about the changes to the capital gains exemption. So the government is worried, is concerned that the current CGE rules that I would call them can be used to multiply the CGE amongst non-active family members. And so the proposed measures that I will briefly summarize. The first one is with respect to minors. So basically, it's game over in Canada for minors for claiming the capital gain exemption under the new rules. And at age 18, there might be a valuation that will have to be done, provided that the child is now active in the business, because otherwise you fall back in the other provisions of the rules, which we will see later. So under the new definition of split income, private company shares, dividend out of private company shares obviously is included under the rules, but also taxable capital gains on the disposition of such shares is now subject to the split income rules. And not only is subject to the rules, but also this means you can't claim the capital gain exemption on such a disposition. So any non-active family person will not be able to claim the CGE under the new rules. And so you have to wonder if you can get kicked out of the rules under the reasonableness test. And let's take a fact pattern here that was outlined in the step letter sent to the minister last week. We have a family member who wants to help another family member in his startup business. So he decides to loan, let's say 100K to the startup and to invest as a passive investor. So for probably non-tax reasons, he's gonna loan to the company so he get a secured loan over assets on the run. And also he's gonna subscribe for a share, let's say for 20% interest in his startup business for a nominal amount because it's a startup and there's no equity value. Now, let's say that the business 5 years down the road is now successful and the shares are now worth $1 million. Loan has been repaid, and now we get to the sell transaction. And we must ask whether the Tossie rule will apply and whether they will be able to claim the CGE on the sale. And when you look at it, well, obviously, the loan is repaid, so there's no contribution of capital anymore other than having paid a buck a share to buy 20% interest in the business. There's no other contribution to the business, no labor contribution or any whatsoever. So clearly, probably the family member will be stuck in the rules and couldn't claim the CGE. So what do we do with existing structures where we have non-active family members that hold shares that have accrued value? And now, well, with the rules enacted, they can't claim the CGE anymore. Well, we're going to see later on there's an election that can be made in 2018 to ensure, to at least bump up the cost of the shares up to fair market value. And we're going to see how it applies. There's also a new limit on trust holding shares in a private corporation. And this is important because I think your clients probably have many structures with family trusts in place where the family trust holds common shares. And that's common when you're doing estate freeze to give you flexibility. For the freezer, you put the family trust in place, and since you might not know at the time of the freeze who's going to continue the business, you might have child still at school. Well, you have the shares being held by the family trust, and later on you can distribute the shares to the child who will ultimately continue the family business on a going forward basis. But now with the new provisions, when the shares are held by a trust, then the trust cannot make any designation of capital gain to the beneficiaries. So it will not be possible anymore for any beneficiaries to claim the capital gain exemption. Now, if you think you could just roll out the assets at cost under 1072 right before a share sale, well, the rules also try to attack this kind of transaction. So what's very important with these rules applicable to family to trust, obviously it doesn't apply to LCG trust, but it's very limited as we've seen. It's only some self-benefit trust or employee trust. So all of the family trusts out there are affected by these rules. But what's also important is that just by the fact that the trust holds the share, nobody qualifies for the CGE, no beneficiary. So even if you have a next generation beneficiary who, in the end, takes the business and is actively involved in the business, well, since the shares are held by the trust, no CGE for the next generation. So I think in practice, a lot of your clients will maybe be reluctant to implementing estate freezes nowadays because the use of a family trust gives you adverse tax consequences for the next generation where the CGE will not be available. And we all know that having a trust in place, there's fundamental non-tax advantages to having a family trust in place. And your client will have to level the benefit of not having a family trust in place and basically deciding at the time of freeze who's going to continue the business and having the ability to claim the CGE, or forego all of the key non-tax benefit of having a trust in place, which I've outlined here. We all know that it gives great flexibility for succession planning. it's a private document. It's also creditor proofing in some aspect. So your client will have the difficult decision to decide whether, well, we go with a family trust for all the non-tax advantages, and we let go the CGE for the next generation, or we let go the non-tax fundamental tax advantages, and we go with the potential CGE for the future gen. So what do we do with existing structures where there's family trust? Under the new rules, there is an election that will be available in 2018. Where you'll be able to create a deemed disposition by filing a tax election and have a deemed disposition up to fair market value to realize your gain and claim your CGE on the gain. This rule will not apply to minors, so you can create a gain for minors. And the result of that is that purification process will have to start in 2017 if you want to meet, in some instances, all of the QSBC requirements. So you'll have to act very quick. What will be otherwise the alternative? Well, it would be to basically do a crystallization. And if you do a crystallization by way of Section 85 and you use an elected amount up to fair market value, that would be the other alternative. But that would mean that you'd have to do evaluation and implement an internal reorg prior to December 31st. So that's a challenge. And for minors, you have to keep in mind that if you want to do the internal crystallization prior to year-end, you have to look also to the existing kiddie tax rules at paragraph 120.44 and 5, where if you do crystallization with a minor, the existing kiddie tax rule could kick in. So that's something that you have to keep in mind. Let's go on to the passive income discussion with Jake.
So again, I think Ted did a really good job summarizing what the policy concerns are in this area and what, at a high level, what the possible approaches that are being considered are. So I won't spend too much time on that. Again, what I wanted to focus on was some of the issues I see with these proposals, and maybe just walk through a couple examples as well. So under the deferred taxation approach that they're calling it, I'm sure everyone's heard this notion of a 73% tax. Basically what they're doing is they're playing with their refundable tax portion. So what happens is when you're in $100 of investment income, you pay 50% up front, and that 50% is meant to be a proxy for what the highest personal tax rate would be, and in Ontario it's pretty close. So the idea in your current system is that you prepay 50% tax, and ultimately when dividend is flowed out to a shareholder, a portion of that 50% is refunded to the corporation, and the individual shareholder can pay whatever their marginal tax rates would dictate. Under this deferred tax approach, the refundability concept goes out the window. And so you pay the 50% up front, right? And that leaves you roughly $49, as shown on the slide. But then if you're a high rate taxpayer and you extract the remaining money as a dividend, that's subject to 45.3%, which would leave you with a whopping $27 left in your pocket. So like the Barbados, probably get it for under $1,000, just saying. So I think a tax like that is just punitive, very punitive, and I don't see how that's a workable solution. But buried in that, like if you take a step back, the 50% tax that I mentioned is really supposed to be a proxy for the high rate payer will pay. What about people who aren't in the highest tax bracket? So now we're going to have people in the middle class or lower that are going to be subject to the 50% taxes, none of which is going to be refundable. And then when they take a dividend, sure, they're going to get graduated rates on that dividend income. But I think there's going to be an absolute cost in that example. Finance seems to be aware of that. So the quote I have on the screen is from page 51 of their consultation document, where they basically make reference to the fact that, well, if you're not a high rate payer, you might want to just pull the money out of your corporation. Seems like a plausible solution to me, but I think there's a number of valid business reasons for wanting to retain cash inside the corporation, whether it be funding future business expansion, trying to plan for an economic downturn and having cash there to sustain your business during that period, these types of things. So creating a tax incentive for small business owners to pull money out of their corporation, to me doesn't seem like good tax policy. And not only that, another thing that may not be clear is it's great if you're a wholly owned corporation, you've got flexibility to dictate whether or not you're going to take the money out of the corporation. What about minority shareholders who might own 5% and don't have any influence in making that decision? They're going to be caught by this trap. I don't want to spend too much time on this slide. I think anyone who watched the Canadian Tax Foundation presentation on Monday would see this, would recognize this slide. What it's showing on the right-hand side is what the estimated value of a defined benefit pension plan is. And on the very left is if somebody maxed out their RSP room throughout their whole working career, or a 35-year career, what the value of that RSP would look like. And I haven't vetted any of the numbers and all that, and I haven't checked what the assumptions were in coming to these numbers. But I think this would be evidence that there's clearly a disconnect between what a pension employee would get in retirement versus what the RSP system currently would allow for. So in my view, if these changes go through and we're truly going to try and discourage people from retaining funds inside a private corporation, I think natural is that we need to relook our RSP room. And is $25,000 or $26,000 a year enough? And based on this slide, I would argue it's not. So I like to think that on July 17th I didn't have gray hair, but certainly I do now. I've spent the last 2 months trying to figure out some of these rules and what it's going to mean. There's this concept of grandfathering, so presumably that's going to mean there'll be a pool of existing wealth, and there'll be another pool that tracks any new wealth that's been added since the implementation date. There's been talk about changes to the refundability system, and changes to how capital dividends are going to be administered in the future. Presumably, again, that would be new pools or different ways of tracking things. And so, I think it's going to be great for accountants and lawyers trying to deal with all these rules, but is it the best use of a small business owner's resources trying to sort through these rules and pay us to comply with them? I'm not convinced it is. And so I want to leave you with the thought of, are these changes really required? And when I look at it, we've got a system where on investment income you're paying upwards of 50% tax. I think that meshes well with what the highest personal tax rate is, and refundability. The refundability system that we have today, in large part, ensures pretty good integration. And what we're really talking about, I'm not convinced, is huge dollar amounts, huge dollar differences, because when I look at excerpts from the discussion paper, you'll see that $100,000 of income subjected to the general rate or the small business rate, over a 10-year period, we're talking, the resultant advantage is roughly $3,000 or possibly up to $6,000. Like, we're not talking huge amounts of difference here. And so I think as part of this, rather than go down the rabbit hole of this huge, complicated reform of passive investments, what we should be considering, in my view, is closely looking at the small business rate, if that's really providing the biggest incentive, and possibly rethinking maybe the 50% tax that's paid up front would be bumped and leave the refundability system the way it is. And I think that would be largely simpler and still meet many of the objectives. And so in terms of planning, I think for now anyway, until there's legislation drafted, my comment would be it's probably best to advise clients not to do too much just yet. So we're going to do a complete 180. I'm going to talk about 84.1, which Ted has already spoken to a bit. I want to do this in a way to set up what Jonathan's going to talk about in terms of the impact on estate planning. And so 84.1, I think to do a comprehensive review of the section would require about 5 hours and probably a case of Red Bull to get through it properly. But I'm going to propose to do this in 5 minutes, so I'm going to go through it fairly quickly. So let's take a simple example. We got Mr. X who owns 100% of OpCo. OpCo's worth $1 million, and let's assume he's got 165,000 of cost base. He wants to extract that $1 million from the company, and so his option would be, well, you can take that as a dividend, and as we know in Ontario, you pay 45.3%, and you'd write a check to Her Majesty for $453,000. So Mr. X doesn't like that result very well. So he tries to get creative and he says, okay, well, I'll tell you what, I'm going to sell my shares of OpCo to a new co that I'm going to own. And when I make that sale, I'll take back the promissory note from NewCo. NewCo is going to be connected with OpCo such that intercorporate dividends can flow tax-free from OpCo to NewCo, which can be used to fund the note to Mr. X. And life will be great because what I'm left with at the end of the day is capital gains rates. And so where 84.1 comes in is it says, well, to the extent that you've got hard ACV, being as 165,000, we'll let you do that. But to the extent that you somehow try to create a capital gain in this scenario, we're going to deem that capital gain to be a dividend. And so Mr. X's plan wouldn't work very well in this scenario because what he's going to be left with is a deemed dividend of 835,000. So slightly better than his result under the other scenario. But Mr. X thinks he can do better. So this time he's going to, he realizes that 84.1 only applies when you sell your shares to a non-arm's length corporation. So he says, okay, well, I'm going to sell my shares to my child, right? The 84.1 won't apply to the sale to an individual. And I won't claim my capital gains exemption because there is a carve out in the definition of this hard cost-based concept for any capital gains exemptions that have been used. So he won't claim the exemption, but so on that sale, he'll again trigger a capital gain of 835,000. His child will now have hard ACV of the full $1 million, and then child will be the one that rolls those shares or sells those shares to NewCo. The same set of factors will occur in the sense that tax-free dividends will flow from OpCo to NewCo and ultimately be used to fund the payment of the promissory note. And under this situation, under the existing rules, I think Mr. X will have achieved his objective in the sense that he's now got capital gains rates instead of dividend rates. So what finance is looking at is that under the proposed rules, not only will capital gains exemption usage be carved out of the definition of hard ACV, but also regular capital gains that are realized by arm's length people, or non-arm's length people, sorry. So in Mr. X's example that we just walked through, under the proposed rules, the child will no longer get the bump to their hard ACV, and will be back in a position where there'll be an $835,000 deemed dividend. So that's 84.1 in a very quick review. I think the key takeaway from that is that an arm's length purchaser can use a purchase company, it's common planning, to purchase a corporation. And by doing so, they'll save personal tax, they'll defer the personal tax as a way of funding the payment of debt. Versus a non-arm's length person, so in a case where there was actually a valid reason for the child wanting to take over the business, under 84.1 as we know today, that child is precluded from using the purchase corporation in the same manner as the arm's length person could, as they would be caught by 84.1 and a deemed dividend result. So it strikes me as being very unfair that our tax system is actually encouraging sales to arm's length people versus the transition of our businesses to the next generation. So with that, I'll pass it over to Jonathan to talk about the estate plan.
Thank you. So I want to focus on pipeline planning, for which the new rules, U84.1 and U236.1 can potentially apply. So put simply, I define a pipeline transaction as practical fix to prevent double taxation on the debt of a shareholder. Basically, what we're trying to achieve is maintain the capital gains tax treatment on debt. As you all know, we're all deemed to have disposed of our capital property immediately prior to debt at fair market value. So you trigger your capital gain on your shares on debt, on the deceased terminal statements. So the pipeline is there to ensure that this treatment is maintained, and there's no double taxation afterwards. And the way you use a pipeline is you use a tax attribute, the high ACV that is being created as a result of that, to affect your transaction. So here is a basic example where Mr. A dies, the shares are worth $1 million, and he has low PUC, and so he realizes a capital gain of $1 million on debt, which is taxed at the capital gains rate, so roughly 26% in Ontario. Now the estates receive the shares with the high ACV, high outside basis. However, there's no inside basis being built because the PUC remains the same, and all the capital assets in the corporation, the ACV remains the same. So what do we do? Well, common planning, which is a pipeline, is that the estate will create a new co. The estate will sell the shares to NewCo at fair market value, which is possible because you have a high ACV as a result of the application of subsection 75. And so you sell the shares at fair market value to NewCo in consideration for promissory, having a principal amount equal to fair market value. You're not caught by 84.1 because you have hard ACV. The deceased has been taxed on this ACV up to $1 million, so the estate has a high ACV, which is hard ACV. We provided that the deceased is not claiming the CGE, obviously. So next step, as we all know in the pipeline, is either that the NewCo and CanCo are amalgamated later on, or there's a redemption of shares of CanCo that are owned by that are owned by NewCo, or you can go with an intercompany dividend, but then you have to wonder if 55(2) will apply to the interco dividend. And so the end result is that you only have a capital gains tax. The estate is able to take some assets out of the company without incurring further taxes because the outside basis has been taxed. So under the existing rule, the overall result, as I said, is capital gain tax for the disease, so 26% roughly. 84.1 is not applicable because of hard ACV created on the debt, which is created automatically by the application of the Tax Act. And CRA has provided numerous rulings, also rulings post-McDonald case, that 84.2 would not apply to these kind of planning, provided that certain CRA requirements are met. Under the proposed rules, Well, the result is as follows. So we still have the capital gain for the disease of $1 million, so you get tax, you get $266,000 going on. And also, the estate would be deemed now to have deemed dividend of $1 million because there would be no more ACV up to fair market value because it would be taking back a note. And so the new rules would apply to recharacterize as a deemed dividend. And so then we're stuck with 45% where we're at 450 here. So on $1 million, where we are at around 71% overall tax on that. And you have to add to that the potential application of proposed section 246.1. Under 246.1, when an amount is receivable by a Canadian individual or trust from a non-arm's length person, in our example is the case, the estate has a receivable from Canco, which the estate controls, so they're non-arm's length office. As part of a series of transactions, there's a disposition of property or increase of stock of shares. It's the case when you repay the note, you take back out some assets of the company. And can it be reasonably considered that one of the purposes is the significant reduction or disappearance of assets of a private corporation in any manner whatever, such that tax otherwise payable by the individual on the dividend from the corporation is avoided? Now that's very broad wording. I think every practitioner in the room here is going to wonder, well, I think this can apply in many situations. So if 246 apply to the pipeline here, well, you get another deemed dividend for the estate of $1 million. So what are the other alternatives then to pipeline if the rules comes into effect? Well, there's still the loss carryback strategy that you can use, where you basically convert what would be an otherwise capital gain on debt into dividend tax rate on the redemption of shares by the estate. So this yields a 45% tax on overall instead of 26%. But what's important is that such a planning has to be implemented within 1 year of death, and the estate must be a graduated rate. So the 1 year requirement in some instances will be very difficult to meet because there can be debate or there can be some issues with potential beneficiaries on how to settle the estate. If no planning is done, well, double taxation. And if there's life insurance to fund the tax on debt, well, you might want to revisit the structure here because you might not have sufficient coverage now. Doing a spousal rollover, well, that's probably just a plaster because you're just deferring tax, so it's not a solution overall. There's two technical issues I want to highlight tonight with respect to the proposed legislation in the post-mortem context. First, there is no relief under the proposed rules for individuals who have passed away prior to July 18. So in some cases, the loss carryback will not be available due to the 1 year requirement. And so these taxpayers, these estates will be stuck with having to pay this double taxation tax. Also, as we all know for pipelines, some of those transactions have been implemented already, but the note hasn't been repaid yet because of the CRA guidelines. You have to repay the note over time based on various rulings that they released. So there are estates out there where they have implemented pipeline transactions and there's a note repayable still to the estate. And you have to wonder if on repayment of the note, the repayment, whether it will be caught by new section 246.1. And if that's the case, it's going to be being dividend to the estate. So there's no transitional rules for those situations. And this is something I think that should be addressed in the proposed rules if there is to be any changes to be made. So I think we're off to the question period. I know there's been many green sheet here with questions from the audience, so we'll be glad to answer your question. I think, Ted, you have most of the questions are for you, so I'll leave you the mic then.
Yeah, so your questions have come up. Thank you both. Thank you to Jacob and Jonathan for your presentation, for putting your finger on some of the for putting your finger on some of the issues that we've noticed and are causing a lot of frustration and concern. Thank you for also doing your best to identify ways in which we can continue to move on and serve our clients. Thank you, Ted, for showing up. I think one of the main frustrations of this has been the way the consultation period has been handled. When the paper was released, it's made, I think, the taxpayer, the community feel like it hasn't been heard, and you showing up tonight assists in mitigating that. I've seen you writing notes vigorously in an effort to respond to the questions. As happy as we are with your presentation, we want more. We want more answers. So what we'll do is I'll let you do your best to respond to the questions that you've got. I know we also have a couple of questions out in the audience. So maybe I'll give you we'll say 10 minutes to do an initial thing here, and then I'll go to the audience and grab some more questions. Does that sound good?
Sure. I'm the one that needs the shorter microphone. Sorry. So thanks very much for my co-panelists, Jacob and Jonathan. I guess what I thought I'd do is, to the extent that I can, there were a few kind of important points that they raised, which we've heard in other contexts. So I thought maybe I'd try and address a few of them before turning to the questions in the green sheets. So I'll just kind of go through in order of the kind of reverse order of what I noted while I was listening. First, with respect to the post-mortem pipeline transactions, we've heard a lot about that so far in the consultation. And I guess what I would do is I'd sort of put the issues we've heard into kind of three buckets. The first is what we think of as sort of purely transitional issues, with respect to deaths that occurred prior, as you rightly noted, prior to July 18th, and particularly those who were more than a year ago, so they can't take advantage of 164.6. So that's clearly been brought to our attention. And 164.6 for a moment, I think that in light of the other amendments we've got going, that 164.6 and how it interacts with the other provisions, particularly our new ones, is something that we'll be looking at on kind of obviously as part of our consideration of what's been raised with the consultation. Finally, there's just kind of the general question on sort of a go-forward basis as to what's kind of the right level of tax when you have the indisposition on death, followed by a wind-up or distributions. One way of looking at it is, well, you've got it's kind of a very final disposition on death, and that should be the end of it. The other thing to note, though, is that, the kind of planning that's used as part of the pipeline after the death is very similar to the planning that's used around 84.1. So that sort of raises the question as to, should planning that arises in that context be different than the tax result for the planning that occurs prior to that. So I just thought I would note that. The other thing that I thought maybe I would try this group, I don't know if it'll work, is sort of the famous 73% and how I sort of think about it. So if you imagine on one side, you've got an individual who earns $100. So let's assume that they pay, tax at 50%. So they've got $50 left over. They invest that. They earn 10% return. That's $5. They pay 50% on that. Their net return after tax is roughly $2.50, right? That's what would happen outside a corporation. When you have the same thing occurring through a corporation, well, if you earn $100 in a corporation, you pay $15 tax. That gives you $85 to invest. If that investment earns 10%, you've got $8.50. If you pay the refundable tax and you make it non-refundable, then you pay $4.50 on that income. That's what's distributed out as a dividend. And then if that's subject to dividend taxation, then you end up with the equivalent $2.50 that you would have had you earned it outside the corporation. So I think the way our analysis tends to start is like one step before most of the people kind of look at it. We look at the source of the investment and how much there is to invest passively in the first place, as opposed to just what's the tax result on $1 of investment, because we think you have to look back one further. I guess one thing I had noted, and I've been thinking about a little lately, is you had mentioned about the purification transactions and how they kind of have to take place in 2017. So to the extent that the private sector's got comments on, the extent that that's doable, not doable, things like that, I think that would be an area that we'd be interested in receiving further comments on, as to whether that's sufficient time for people to do sort of the elections in 2018. Those were kind of the main things that I sort of noted during the presentation. I'll just read a few other questions. I don't know whether I'll be able to answer all of them. So the first question is facts. Mother and daughter started a clothing boutique corporation. The mother lends the corporation $100,000, but otherwise does not work in the store. Year one, the store loses $10,000. Year two, the store earns $50,000. The mother's income is other income is $50,000, so presumably that's aside from any involvement with the store, and she would like to draw $25,000 from the store as a dividend. Under current rules, the marginal rate is the marginal rate of the dividend is about 17%. If deemed to be unreasonable, the rate on the dividend would be 45%. And then the first question is, how are the proposed tax rules neutral? The second one is, are these numbers representative of the top 1% of the population? And thirdly, how will the additional tax affect the economy? I guess I'd propose to deal with the first question from sort of a policy perspective. I mean, the way we've chosen to go with respect to TOSI is, as I talked about earlier, TOSI does apply, flat top rate taxation, regardless of the minor's income. And I think as an extension of that, it is the other way to do it would be to develop an attribution rule. Right? I mean, if you're, if you accept the proposition that income is being sprinkled, then, the other way to do it is say, well, who's the sprinklor and who's the sprinklee? And it wasn't clear to us in sort of how it would be possible to develop any sort of system in the private corporation that would attribute the income to the right person so that you have the right rate. So I think that just kind of addresses it. With respect to how are the numbers representative of the top population, 1%, obviously the example that you suggested precludes them being in the top 1%. I think what I had showed earlier indicates that, in fact, the benefits to income sprinkling certainly go up as people go up the income scale. So I think that's what it refers to. And what's the effect of the additional tax on the economy? I think that kind of depends on how taxpayers respond. And actually, that just reminded me of another point I was going to make in response to what Jacob's scenario about the student who's working part-time in summers and things like that, and how they would be able to take dividends. I guess I just kind of note as an aside, I've certainly had this conversation with other people, and at least in one conversation, I sort of said, well, what's the commercial imperative? What's the business reason for preferring dividend payments to your 21-year-old as opposed to paying them for working in the business in the evenings and during the summer? And I guess when we're thinking about the neutrality of the tax system, the answer I got was, well, the dividends are taxed in a better way, so that's why we prefer to use dividends over salary. So I guess there's puts and takes on either side. The current system has an incentive to pay people by way of dividends as opposed to perhaps by other ways. I'll turn to the next question. The proposed tax changes have been compared to 1972 tax reform, where the consultation period was significantly longer than the 75-day time frame. How did the government determine the 75-day period was a reasonable consultation? Is there any indication that the consultation will be extended? We've seen and signed numerous petitions requesting an extension. I think really all I can say to that is the determination of consultation period is something that's done at a governmental level and it takes into account a wide range of factors. And I don't think I can point to any one thing that led to particular 75 days. I do know in my experience as director of tax legislation that, and I don't think it's quite to this, but in general, finance is generally thought to often have consultation periods that are too short. Can you give us any indication of timing of when the release after consideration of submissions during the consultation period? I think that'll depend on government's priorities and how they decide to go forward and what the government hears during the consultation and kind of what the analysis and their way to go forward. So I don't have any particular sense of when a response would be provided or exactly what the next response will be. Next, is there really a correlation between the reported sharp rise in incorporated entities and tax planning by the wealthy, or is that rise, attributable to the ability of professionals to incorporate governments' own attempts to offload payroll to subcontractors who are forced to incorporate? Are we again following the lead of foreign reporting and providing a very fine net to extensively catch relatively large fish? I guess with respect to the with respect to the first, I think there's lots of anecdotal evidence that supports the view that a goodly number of corporations are driven by the tax benefits that can accrue to the principals through that corporation. I think when we were at those that were at the conference on Monday noted that I think at least one speaker kind of pointed out if you do a search on Google, there's lots of material up there about sort of the benefits that taxpayers can gain from a tax perspective by incorporation. We'll just see if there's a couple here.
Yeah, do you mind, Ted, if we go to the audience now for a question or two? We can come back and forth. Dan, you wanted to ask a question?
Thanks, Steve. Ted, a question for you about transitional implementation for TOSI. I want to go back to an example that Jacob presented. He presented a situation where we basically had two Canadians who had a corporation, and they accumulated wealth in their corporation for, let's just call it the last 30 years. He mentioned 2000, but historically, since at least 72, there's been an incentive to use or accumulate wealth inside corporations. Whether we like the policy, we don't like the policy, the reality is those were the rules in which Canadians operate. So we get to today, and we have a suggestion from Minister Morneau in his open letter to Canada, saying, and in fact he said, let me be clear, we are not going to impact the retirement of Canadians. He said it again last week at the CPA conference here in Ottawa, and then I heard it on Monday from one of the members of finance. So I take that to be a genuine desire not to jeopardize retirement. I look at the transitional relief provided for passive income. The basic concept is for whatever wealth has been accumulated to date inside those corporations, those individuals have taken advantage of what finance considers to be an appropriate use of reinvesting the 35% if they're earning business income and 15%. So we're not going to plow that back. Yet when I go to Jacob's example, and I look at a couple, call them a plumber, and they've accumulated wealth for 30 years, they're at that point 500 grand in their holdco or 800 or whatever it is, and frankly that's not that much to retire on when we look at the amounts needed for retirement these days. They make the decision to retire, maybe they sold their business 2 or 3 years ago. Now what we find is that they're subjected to top marginal rate when they draw the dividends out of the corporation. Although we don't like the idea, or current finance thinking is, that they don't like the idea of this dividend sprinkling, we're jeopardizing retirements. So I'm wondering why there is no transitional relief under TOSI. If you wanted to limit the amount of relief, you could always look perhaps to the economist amount that they identify as being the 2 million, 2.5 million, whatever that pensioners may retire with and a computed value of the pension. Surely we can identify an amount that can continue to be dividend sprinkled from, if you will, the retirement fund, because I can tell you business owners don't think that it's inappropriate, what the rules were, and it is their pension if you were to ask a business owner. You can clearly set limits on that, exclude the kids, but leave it with spouses. I'm curious on your idea, what your thoughts on that. Thank you.
So just on that, I guess I think this is one of those questions where, I mean, the way TOSI applies is with respect to obviously, current paid now. Looking at past transactions per se. To the extent, I mean, I'm just trying to sort in the sense that I think this really is something that perhaps, that is a response that it should be put to the consultation, because I guess thinking about it as you're raising it raises a whole host of questions. So I don't think it's something that there would be a simple answer for, in the sense that, when you say 2 million, is that everyone? Is that people who have existing assets? I think where the discussions have largely been around, and I think you kind of acknowledged it, about existing stocks has been with respect to the treatment of the passive income and how that will be dealt with under proposals going forward. TOSI, as it's generally been structured now, has been, with respect to a test that relates to contributions, financial, labor and otherwise, to the business to sort of stake out a grandfathering, a more, a complete grandfathering based on rights within a corporation for individuals, I think would be certainly a significant addition to the proposal that was released in July. So I guess the retirement, I think I'd recommend that submissions be made with respect to that.
Thanks, Ted. I also know Gary from Crow BGK had a question.
Hi. So the government's narrative in selling this to Canadians is that this legislation is really applying to the top wage earners or income earners in the country, the top 1%. And the implication is that the middle class is being helped along the way. That's been their discussion all along. They're looking after the middle class, only taxing the high people. And all the narratives so far are all talking about the doctors and the money that they need. But we know as practitioners that this affects all of our clients. And we have clients that are at all ends of the scale. And the implications to them is still significant on a relative basis. So the extra dollars that you're going to be taxing somebody at a high rate are just as important to them as it is to somebody who has, in Dan's case, the $500,000 pension. Those extra taxes are going to be just as impactful on them as well. So I'm just wondering how you reconcile the definition of middle class that the government is selling this as being protective of versus the legislation is affecting everybody. So it's affecting the middle class and all classes.
I think with respect to that, so certainly you're correct in the sense that, for example, with respect to TOSI, if the dividend is paid and the criteria are met, that a determination has been made. A determination has to be made as to whether or not it's reasonable or not. The data that we've got kind of suggests that the cohort where income sprinkling is occurring, that is sort of dividends to multiple family members is relatively small from the overall population. I don't know whether that sort of lines up with your anecdotal perception. And with respect to the passive investment income, I think sort of the point there is that for lower levels of income, individuals can achieve similar results through, sort of the government sanctioned savings plans like RSP, TIFSs, and things like that. And that the real benefit with respect to passive investment income can essentially represent sort of an unlimited RSP in terms of the kind of returns you can earn, and also without any limitation on the types of investments that can be made.
Ted, I mentioned earlier that we were broadcasting this across the world. I've received a question from somebody who is watching via our YouTube channel. And the question is, this is from Joe Devaney in Alberta. The question is, has there been an analysis of the cost of compliance and administration, both from the taxpayer and CRA's perspective, especially in light of former Chief Justice Ripp's comments made earlier this evening?
Well, I don't think there's any particular figures I can provide with respect to what the expected costs either by the CRA or individuals more broadly would be for complying with any particular element of the proposals.
Okay, maybe I'll have you return to those green question sheets there, Ted. Got 10 more minutes.
would there be any additional possible culpability, responsibility placed on professional tax preparers to determine reasonableness? I think the only response I've got to that is there's no additional provisions being added to the Act with respect to the reasonableness test that is being proposed. And just the last one, instead of tackling interspousal splitting, why doesn't the government recognize a two-partner household as a single economic unit and allow joint filing of tax returns? Seems to me that this would eliminate all discussion of reasonableness for salary and dividends to spouses. Joint filing would eliminate a huge compliance burden on both the CRA and the taxpayer. It is time finance seriously consider this. Given the last statement, I think that's more a suggestion than an actual question. So I'll leave that there.
Okay, well, I think that brings us to the conclusion of our evening. I'd like to thank you all once again for coming. I'd like to thank our speakers again for coming. And Ted Cook, thank you very much for answering those additional questions. And we look forward to seeing the Department of Finance's response to the many consultations and comments that have been made. Thank you all very much.